You know how companies like Shopee or Lazada make millions in sales, right? Well, have you ever stopped to think about how they deal with the fact that some customers just never pay? That's exactly what we're getting into today. If you're gearing up for the LECPA, this is your secret weapon to absolutely master the percentage of sales method.
Okay, so here's our game plan. We're going to start with the why, get into the nuts and bolts of the calculation, see how it all connects, and then, my favorite part, we'll cap it off with some pro tips to make sure this stuff sticks in your brain for exam day.
All right, first things first. Why do we even need to estimate this stuff? Well, it all boils down to a fundamental risk of doing business.
Imagine this. Your company just had a killer year. 8.5 million pesos in net sales. That's amazing, right? But here's the reality check. That big number on the sales report isn't the same as cash in the bank. Not everyone's going to pay up.
And that loss? Well, it has a name. Bad debt expense. You really have to think of it as just another cost of doing business. If you want to offer credit and make more sales, you have to accept that some of those sales will go bad. It's that simple.
So we know we're going to have losses. The big question is, how do we estimate them? Well, there are a couple of ways, but today we're zeroing in on the one that's all about sales, the income statement approach.
Okay, pay attention because this is super important for your exams. You have to know the difference. The balance sheet approach looks at the end goal, the final allowance balance. But the method we're talking about today, the income statement approach, it is laser focused on one thing, calculating the expense for the period to match it with the sales of that period.
If you only remember one thing today, let it be this. The percentage of sales method is a direct line, a one-step calculation to find the bad debt expense. That is its entire purpose.
And check out the formula. It's honestly as easy as it gets. You just take your net credit sales and you multiply it by whatever percentage you think is going to go bad, which is usually based on past experience.
All right, enough theory. Let's plug in some actual numbers and see how this plays out in a real problem you might face. So here we go. Step 1, you grab your net sales number, 8.5 million. Step 2, you take your company's estimate, in this case, 10%. You multiply them together and boom. Step 3, you have your doubtful accounts expense for the year.
And that's it. That P150,000 is the number. That is the bad debt expense that's going to show up on the income statement, see? With this method, you've directly calculated the expense. No other steps needed to find that specific number.
Now, how do we put this in the books? It's a classic adjusting journal entry. You debit the expense, that hits your income statement, and you credit this special account called Allowance for Doubtful Accounts. We'll talk more about that one in a second. And this quote right here just hammers the point home. The whole emphasis, the entire point of this method is to find the expense. Why? So we can match it against the sales from the same period, giving us a way more accurate picture of our real profitability.
Okay, so we've got our expense. We made the journal entry. But where did that P850,000 credit actually go? Let's pull back the curtain and see how it fits into the big picture.
So, the allowance for doubtful accounts, or ADA, is what we call a contra asset. Think of it as a negative account that's always attached to accounts receivable. Its whole job is to shrink the gross value of your receivables down to what you actually think you can collect.
And this right here, this is the aha moment. See that P85,000 expense we calculated? It's just one piece of the puzzle. We take the starting balance in our allowance account, we add our new expense, we add back any money we got from customers we'd already given up on, and then we subtract the accounts we officially wrote off this year, and all of that gives us the final ending balance in the allowance account. All right, you get the theory. Now let's talk strategy. How do we turn this knowledge into cold hard points on the LECPA? Let's break it down. Okay, get ready to screenshot this or burn it into your memory. These are the 4 things you have to know. 1. It's an income statement method. 2. It directly calculates the bad debt expense. 3. And this is a big one. You totally ignore the beginning allowance balance when you're finding the expense. And 4. Remember that the expense you calculate is just one piece of the final allowance puzzle.
Here's your mental cheat code for exam day. The moment you see the phrase percentage of sales, your brain needs to fire off this exact sequence. 1. This is an income statement problem. 2. My only mission right now is to find the expense. 3. The number I get is the answer to the expense question. This simple checklist will stop you from falling for those trick questions that throw in extra numbers just to mess with you.
And there you have it. That's how you take down the percentage of sales method.
You now have the tools for the exam, but I'll leave you with this final thought. Getting the calculation right is great, but the real-world skill is being able to stand your ground and justify why you chose 10% in the first place. That's where you go from student to pro. Now go crush that review.